Investing is like a roller coaster. There's ups and downs, and if you play your cards right, you can make a lot of money. But before you get started, you need to know which investment strategy is right for you. There's many different strategies, and honestly, I've heard all of them. I've heard buy low, sell high. I've heard, hey, the latest meme stock, the latest crypto, but they all have their pros and cons. So in this video, I'm going to discuss some of the most popular investment strategies and their pros and cons, and then I'll decide which strategy is right for you depending on your risk tolerance, age, etc. If I flip over to my screen here, you're going to see I've got 5 different investment strategies. So the first one is buy and hold, and this is a long-term strategy where you buy stocks and you hold them for a long period of time. Pretty simple, regardless of market fluctuations. The goal is to ride out the ups and downs and come out ahead in the long run. So one of these stocks that I put in the buy and hold, and I'm going to link this down in my description below, but these 3 stocks here, Procter Gamble, Coke, and Johnson & Johnson, they all have great dividends. If I click into Procter Gamble, they all have a long track record of returning value back to their shareholders. They have a pretty good dividend, 2.42%. And if I zoom out from the 5-year, you've got a 92% increase. So if you held this for the last 5 years, you've made 92% on your money. Also, the volume's pretty high, so you see a lot of institutional investment coming from that. Another one is Coke. Everyone's heard of Coke. Coke's a huge brand. Warren Buffett's a big investor in Coke as well. You'll see a great dividend here. I can't remember what it is off the top of my head, 2.82%. And a lot of institutional volume. You'll see over the last 5 years, we've got a 41% increase on shares. So you see back in right when COVID hit, they were $60. They went all the way down to $38. So if you were smart enough to actually pick up Coke during COVID, you've actually made some really good money. Now, if I go back here, the last one I look at is Johnson & Johnson. Johnson & Johnson is a household name. They do things like Q-tips, baby powder, kind of the consumer discretionary, consumer durable. They've got another great dividend, 2.73, a lot of institutional investment there with high volume. And if I go back another 5 years, you're able to see shares have appreciated 26%. So not quite as good as Coke or Procter & Gamble, still doing very well. The next type of investing I'm going to go into is what's called value investing. So this is an investment strategy where you buy stocks that are undervalued by the market. Value investors believe these stocks will eventually appreciate as the market returns their true worth. So 3 I put in here in value investing would be Berkshire Hathaway, JP Morgan Chase, and Walmart. Now Walmart is a very interesting story. They're competing with Amazon e-commerce dominance. I've actually started using Walmart for some of my other items that Prime either doesn't have in stock or takes a little bit longer. And so far, I have been very happy with the service I've gotten from Walmart. But if I look here over the last 5 years, I'm seeing an appreciation of 72%. They do pay a dividend, of course, not as good as what you'll find in the buy and hold, but the volume's a little lower. And over the last 5 years, they've returned 72%. So not too shabby there. Again, if you believe Walmart's undervalued, you believe their book value now is at 400 billion market cap, you think it's higher, this could be one to look at in order to really gain some price on the multiple there. JP Morgan Chase, I put this in as well into value investing because interest rates have climbed. We've got a different macroeconomic environment, a lot of the money printing over the last few years. I decided to put JP Morgan in there. They do have a yield, pretty good, 2.8%. Tons of volume. JP Morgan Chase is in almost every portfolio, and they've returned about 25%. So I think JP Morgan is definitely undervalued for sure. I definitely see it continuing to make its way up into the north as we continue to hopefully pull out of this economy and come back even stronger. And the last one's Berkshire. Berkshire is Warren Buffett and Charlie Munger's company. They own real estate, they own Dairy Queen, they've got subsidiaries in just about everything. Over the last 5 years, they've netted 66%, and that is not a typo. That is $496,000 a share. So for those of you that are not familiar with Berkshire, they do have it is $496,000 for one share of Berkshire. It's simply incredible. They don't pay a dividend either. They have negative PE, and their volume is very low, obviously, because a lot of institutional investors do not want to buy a stock that is $496,000 share. So the next type of investing is what's called growth. So growth is an investment strategy where you buy stocks that are expected to grow at a faster rate than the overall market. And growth investors believe these stocks will continue to grow and they're willing to pay a premium for them. So no surprise here, we've got Tesla, Nvidia, and Amazon. So for those of you that have followed my channel for a while, you'll know I am pretty bullish on Tesla. Not so much their price per earnings over the last 5 years, but I don't see Tesla going anywhere. If you can handle the high volatility of something like a Tesla or an Nvidia or an Amazon, I think you could make quite a bit of money over the next 5 to 10 years. So if I look at the first one, Nvidia, I definitely see Nvidia here from a growth perspective continuing to go up. Why? AI, machine learning, computational machine learning, sensory on cars, robotics, biogenomics, gene splicing, gene mapping, all these things that NVIDIA is known for, data center. Really everything today has a GPU or graphics processing unit in it. Teslas at one time had NVIDIA GPUs in them. Phones are starting to get small GPUs. Even laptop computers are now getting small NVIDIA GPUs put in them. Now they have a very small yield, but over the last 5 years, they've returned 361%. So if you were smart enough to get in when COVID hit, which was around, let me go back here, we'll call it right here. It was $51 a share, and now it's $267 a share. Market cap $660 billion. I really do think Nvidia is one of those that's going to continue to rally. So if you can pick some up, down on the dip, but even if you had picked some up right here at 329, I still think over the next 5 years you're going to make money on it. Tesla's a great stock because you have such diversification. So you have solar, you have cars, you have the collaboration with SpaceX from Starlink. They don't pay a dividend. They don't really need to. But the volume is high. A lot of people want to get in on Tesla. If I go back 5 years, you're up 828%. That is not a typo. So the last 5 years, it's split a few times. I don't have the split adjusted price here, but it was $19.93 5 years ago, April 20th, and it continues to just crush it. I think in the next 5 years, before split adjustment, you're going to see Tesla probably around that $350 to $400 share within the next 5 years. So potentially, again, doubling your money. The only thing I would caution about is Tesla has just been a continued short sell. A lot of investors, a lot of hedge funds have continued to short Tesla, thinking they're going to make money. I think some of them have, but overall, Tesla has just went straight up and to the right. Every few years. If I zoomed out from the time they IPO'd, I believe back in 2012, it's straight up and to the right. You've never lost money on Tesla. And the last one's Amazon. Everyone knows about Amazon. Everyone's very familiar with Amazon. You shouldn't be, if you're watching this video and you don't know what Amazon is, you might want to wake up from under the rock. But Amazon does everything. They're in just about everything. I just recently read they're getting into pharmaceuticals. Amazon over the last 5 years has returned 42%. I think it is a really good growth play here. I think that Amazon will grow faster than the broader market. I know their new CEO, Andy Jassy, came from AWS and helped do a great job there getting that off the ground. A little over $1 trillion market cap. I don't think there's a limit on where Amazon can go unless they get it. If it's the only way Amazon loses is, through their own actions, I think it's theirs to lose. All right, next one, dividend investing. It's very familiar. So those of you who watch my channel, you know what I'm about to say. This is a strategy where you buy stocks that pay dividends. You believe that these stocks are a good way to generate income from the investments, and you want to hold these for as long as you can. So IBM, Verizon, AT&T, they all have great dividends. So IBM's been paying a dividend since it was incepted. If I go over the 5-year mark with IBM, I believe they're down 18%, but their dividend is 5.15%. So very good dividend there if you're willing to hold IBM. I think they might be up over the 1 year, 1%. These are things that I would add to your portfolio to balance it out. I wouldn't try to go all in on something like an active or a value or a buy and hold or even a dividend. I would mix them all up, and I've talked about that several times on my channel about how to create a balanced portfolio. I'll put a description up here for a link on how to create a balanced portfolio at any age, so be sure to check that out. Verizon's another one. They probably own a half or a third of the telco market in the United States. Over the last 5 years, down 18%, but they pay a great dividend at almost 6.5%. High volume. If you've held them over the last 5 years, you've lost money on the stock, but you may have made money over that from a dividend. Again, you're getting paid no matter what happens to the stock. It goes up, it goes down. Obviously, you want to see both, but that's not always the case. And then the last one I'm going to put into the dividend is AT&T. Again, taking up the other half of the market is AT&T. They have a 5.5% dividend here. Something else that Warren Buffett talks about is holding one of these stocks like AT&T as long as you can. Same thing he does with Coke and IBM for their dividend. Okay, last one, active trading. Now this is exactly what it sounds like. You actively trade daily, weekly, monthly, sometimes yearly these stocks. So Netflix, Meta, or Facebook, and Apple. One thing to be cognizant of with this is this does not mean shorting. This means buying low, selling high, trying to time the market. And what's the point with all this? Well, this is an investment strategy where you buy and sell stocks frequently in an attempt to profit from short-term price movements. So active traders are monitoring the market. You're looking for opportunities to buy low and sell high. This is not something I would recommend for somebody who's new to trading, who's new to investing. Again, I've talked before, most people are fine buying a S&P 500 or a NASDAQ ETF that mirrors the market, collect your dividends, and collect your 8, 9, 10, maybe 12% a year. But you don't have to do anything, right? You don't have to sit around, you don't have to monitor, you don't have to be in trade station, you don't have to have a Bloomberg terminal, and you're not watching the news every day. Most people have lives and they don't want to sit around and do that, and I fully understand. So on the active trading route, I put 3 in here, Netflix, Meta, and Apple. Netflix, and you could probably almost put Tesla in there too. I know I put Tesla in the growth. It almost could be in the active as well, just from the volatility. But Netflix has had an insane amount of volatility over the last 5 years, but you've netted 7% over the last 5 years. The problem though with Netflix has been competition, plain and simple, from Disney, from Hulu, which is owned by Disney, and through Amazon Prime. Netflix just wasn't what it was. I still think it's a great company. I still think they've got great leadership. No dividend, of course, none of these do in the active category, but I think it's still a great stock to own. And if you're watching it daily, depending on what some of their competitors are doing, you might be able to pick it up low here and then sell it up here. All right, let me go back. Meta's another one. With the metaverse, they've really made some interesting choices. Probably not what I would have done, but they've made some interesting choices. So if you are an active trader, it's a great opportunity when they announce something like over here. I think this is when they announced the metaverse, and you've seen the stock go from a 331 all the way down to 187. So if you're smart enough to pick some up at 187, it's at 221 now, you're definitely making money. Also, go back to November 4th, $90 a share, and now it's 221. So, I remember they missed their November 4th. I think they missed their Q3 number, and it just absolutely tanked the stock. It just went down, and then it slowly climbed back up. Again, no dividend, but if it's something this is another stock I'd watch, and you could probably pick some up low and sell it high. And then the last one is Apple. Apple's been through a lot over the last few years. I think they're one of the last ones to hold off on doing a reduction in force or RIF. But Apple's another one where over the last 5 years, 276% return on your money. So more of the up and to the right. Apple's in basically every portfolio out there, every ETF, every mutual fund, every index fund, every retirement account. But there are opportunities to, again, sell it up here, buy it down here. So last summer, $131 a share. Now they're at $164. So something to keep an eye on. The investment strategy for you will depend upon your risk and your circumstances, your goals. If you're looking for low risk, an investment strategy, buy and hold could be a good option. If you're looking for more profitable investment, value investing or growth may be a better choice. And if you are looking for a way to generate income, dividend could be a good option. And if you're looking for a way to make high returns, you could also get on the active trading. There's not necessarily one way to go for everyone. Make sure you mix and match what works best for you. And as always, remember to design your financial freedom. Take care. Bye-bye.